back. Now, we've been talking about how to code in R to do some performance evaluation about your portfolio strategy. You're going to develop your own trading strategy for this class, and then by that, you will have to construct certain portfolio. And the video lecture before was talking about some risk measures, right? VAR, beta, and all this kind of stuff. How dangerous is it? Okay, likelihood of losing money, and then the dollar value that you estimated, right? Another thing that you have to worry about is portfolio rebalancing, dynamic rebalancing versus not. And then based on those, you saw the difference in terms of Sharpe ratio, right? The excess return for each unit risk that you take, okay? Um, so this time we're going to talk about factor analysis to analyze your portfolio's return using some existing factors in the risk return trade-off model. Okay, Fama French 3 factors, 4 factor model. We're going to talk about it, how to do it, and then analyze, right? How to explain your portfolio strategy return is coming from each of different factors. Okay, should be a combination of these factors, and then some part of your return may not be explained by those existing factors. Then you have a go, which means you are making money out of it. That's your ability of yours shown in your portfolio. If not, and most probably, most of the time, everything that you do in your portfolio returns will be completely explained away by this Fama French 3 factor models, 4 factor models, or n different factor models. Okay, but let's hope that you will be able to deliver some excess return, which is shown as alpha. All right, anyway, factor analysis, how do we do that? Most investment portfolios are a collection of risk factors, such as credit and equity risk, also known as corporate bonds and stocks. Target specific factors may or may not be may not be the intent, but the risk factor profile is always a crucial influence of portfolio results. Hence, monitoring and managing this factor is crucial for a clearer view of what is driving a portfolio. Decomposing risk with factor-based analysis offers deeper insight. So, decomposing risk can take many forms. The basic approach is analyzing a portfolio based on its components. A simple risk contribution profile of component securities is usually a good way to begin, but a security-based review merely scratches the surface of the possibilities. Knowing that, say, one ETF in your strategy is a source of 60% of your portfolio's return volatility, or that the 3 funds represents 90% of the volatility is useful information. But every fund represents a mix of factors, which means that you will have to go deeper for a complete accounting or explanation of risk and return drivers. That's why factor-based analysis is important. And conceptually, factor-based analysis is easy. Select a set of relevant risk factors and regress the portfolio's returns against the returns of indexes representing the relevant factors. In practice, however, the details can be tricky, and so it's best to have a clear idea of your goal before you start crunching the numbers. The main issue is selecting the risk factors for the portfolio on the scrutiny. This is where most of the heavy lifting takes place. For instance, are you focused on the macroeconomic factors such as inflation, interest rates, and so on? Alternatively, you can emphasize financial factors such as value or growth for equities, or term structure and default factors for bonds. Or maybe it's wise to combine macroeconomic and financial factors. decomposing S&P 500 risk with the Fama French three-factor model. That's the first attempt that we're going to do. So here we are going to try to decompose the return of the S&P 500 index returns into Fama French three factors: market, size, book to market. Isn't S&P 500 index already a market index already? Yes and no. Okay. The market index that we're going to use over here, it will be based on all the stocks in the United States, 6,000 different stocks, not top 500. So small stocks, mid-cap stocks are excluded in S&P 500. So that's why we still can do this kind of decomposition. Let's use the Fama French three-factor model to decompose the stock market's factor via the S&P 500 monthly returns. The model advises that most of the market's returns can be quantitatively explained by three factors: market risk, the excess performance of small cap stocks over large caps, and the outperformance of so-called value stocks, i.e. companies that are underpriced relative to their book value, steel company kind of, or Volkswagen kind of, versus highly valued shares like glamour stocks, or growth stocks, I would say. Okay, the question is whether one or more factors explain a greater or a lesser proportion of the returns. Factor analysis offers a quantitative answer. Right. Some of you may question, where can I obtain those factors? Don't worry. Okay. That's going to come from certain place. Kenneth French's website. The first step is to load the equity market's factor premiums by downloading the data from Professor Ken French's website and processing the file for use with factor analysis. Of course, you may wonder, how do we construct those factors like what Ken French did, right? Essentially, to do that, you need a PhD in finance to seriously study that one, or at least master in finance, the master of science in finance, not MBA. Okay, you need a couple of years of serious study like crazy, doing all kinds of math, all kinds of economics, and then construct those things. Essentially, this one will be, the factors would be the portfolio returns in its own right. What do you mean? Well, size factor, for example, okay? Size factor will be size-based portfolios return. The basic idea is those factors will be a long-short portfolio because as I said before, the asset pricing model is about risk, understanding the risk premium, right? Your risk premium should be, like, it could be a risk premium of a stock, or it could be a risk premium of a portfolio. Should be a linear function of other risk premia or premia. Okay, let's say market risk premium plus beta times risk premium related to, let's say, size. Okay, now, having said that, the risk premium being there, why do you say this is a long short portfolio? Because risk premium is always like something excess return concept, excess return. So this is, let's say, a stock's risk premium should be your stock's return minus what? Risk-free rate, right? That's long short portfolio, longing your stock and then shorting risk-free asset. That means you first borrow at risk-free rate and you got a cash. With that cash, buy your stock. Okay? Okay, borrowing risk-free, is that possible? Let's say it is possible. Let's say you are a hedge fund by a Nobel Prize winning economist. Everybody will lend you money for free, risk-free, I say. That's what the LTCM did, right? Anyway, so long-short portfolio is already created over here as you see it. Oh, we can interpret it that way. That's it. That's what I'm talking about. Risk premium, long-short portfolio. Now, that's left-hand side variable. The right-hand side variable is here. What did I say? Market risk premium. It is market portfolio's return minus risk-free asset. And then plus beta times return of size portfolio risk premium. That is small companies return and then big companies return kind of things. So risk premium, risk premium, risk premium. Okay, your premium is explained by the rest of the premiums over here. This is more systematic components, right? Market portfolio, long short again, the shorting risk-free rate, risk-free asset. Borrowing at risk-free, buying those market index. And then over here, what do you do? Long position for small companies and then short position for big companies. SMB, the size factor is this one. Yes, we are all taking long short positions. All these arbitrageurs, right? Take this long short position, and then these arbitrageurs enforce the law of one price. Okay, law of one price, no arbitrage. Otherwise, there will be arbitrage opportunities. So for this no arbitrage opportunities to hold, this long short position will wipe off all the possible risk taking, the profit taking opportunities. All those unexplained profit taking opportunities or free lunch will disappear as long as you take this long short position and then do the arbitrage. Right? That's the concept of arbitrage pricing. And then that is over here displayed in terms of factor model. Okay. So that's basic idea that we are talking about. Now for this part, I said those long short portfolio, they can be constructed, okay, at least in the data, so that they can trace back those portfolio returns and construct the returns of long short portfolio with respect to size and with respect to book to market, with respect to market versus risk-free rate. You can construct that factors yourself. That's portfolio returns. Library XTS is needed for this discussion. And then download those files from here, Ken French's website. Professor Kenneth French has a great data library where he keeps on updating those factor returns, or factors, right? Portfolio returns based on all those factors. Yes. Then names, all these things, date, market, SMB, HML, RF. What is that? MKT, market. That's based on thousands of different stocks. Average returns, right? Average return. Time series is there. SMB is small minus big. That's a size-based factor. And then HML, high minus low. That's book to market factor, right? And then risk-free rate, RF, obvious. Now, Fama French 3-factor models, what do you need? You need second column, third column, and fourth column variables over here. That's why we have 2 to 4. And then extract it out and then take it to Fama French factors 3. And then year, month, you have to standardize the date format. Okay. For S&P 500 returns, we can use the manager file in performance analytics and the convert the monthly dates to a first day format with the index AT first of function. Option in the monthly on the 2 monthly command to match the format in FF3 factors dates. The code also creates a history of the S&P 500's risk premia by subtracting the 3 months T-bills performance from the equity market's monthly return. So install packages, again, performance analytics. We have that. Yeah, it should be there. And then we're going to activate it through library command. Yes. And then see manager's file. And then return T-bills, right, will be extracted. And then return premium will be also extracted which is return T-bill 1 and return T-bill 2. Okay, so let's see the return T-bill over here, that file. Return T-bill. Nah, that's a vector. That's why we don't see it. But anyway, so you can check out later. Return T-bill over here. Okay, time series. Now, yes, column names, right? S&P 500 return premium. S&P 500. Yes, S&P 500 return premiums. I need to. Yes, S&P 500 return premium. Yes, that's this guy, right? And then T-bill. You see S&P 500 returns and 3 months T-bills. So we got to subtract it, right, out to get the long-short portfolio. Okay, excess return. Anyway, we also need to trim the length of the factor premium file to match the relative short S&P 500 risk premium date in S&P 500 red premium data set. This is done by subsetting based on dates to create FF factor subset. As shown below, we then combine the S&P 500 returns premium and the factor premium in FF factors SP 500 return premium. The thing is, the data name is very long, but it's, don't get confused. Okay, so you do all these things, and then FF factors S&P 500. Where are you? FF factors, right? Factors S&P 500 return premium. Yeah, that's this guy. You see market, SMB, HML, S&P, right? And then now we can perform linear regression with the 1 month function, LM function, I'm sorry, LM, linear model. What am I doing here? Right, capturing the output in S&P 500 factors like this, and then we want to see the summary of the result over here. Now what do we have? We have a regression result. We regressed S&P 500's excess return relative to risk-free rate, regressed on the rest of the factors, the variables, right? Market, size, booked market. So those beta estimates are shown over here, and then the T-stats are shown over there. 98. Holy cow, it's no kidding, right? Very, very significant, extremely, right? And then SMB, minus and significant, like this. Minus means like those component stocks in your dependent variable portfolio, which is S&P 500, that's more likely to be big stocks. Minus sign over here implies that that's closer to what we shorted in this factor, okay? You will remember size factor was longing small stocks and shorting big stocks. Minus means your portfolio is tilted towards big stocks. HML is positive and significant slightly. It suggests that weekly your portfolio S&P 500 is closer to more of a value stocks, like blue chip kind of value stocks that is not correctly priced yet. Not that much. Of course, it is usually correctly priced because this is big stocks, but can be more tilted towards high book-to-market stock a little bit. Factor loading, that's betas, right? We call it the betas or the coefficients as a factor loadings, whereas those risk premia are called factors. Factors times factor loadings, right? The market factor scores the highest reading. That indicates the S&P 500 index. Fluctuations are primarily driven by the broad stock market influence. Not surprising, yeah, modestly negative beta of small cap, yeah, as I said before. The adjusted R squared reading of 99 suggests that 99% of the S&P 500 indices are explained by the three-factor Fama French, right? The low p-values in the far right column for market size and book to market, like this, indicate that we can reject the null hypothesis for these factors. In other words, the results are not likely to occur by chance, by random chance. Accordingly, these factors offer a meaningful lens for deconstructing the S&P 500's risk profile. Now, no wonder market comes from CRISP Universe. That's Center for Research of Security Prices, CRSP, University of Chicago's institute, which is the market index based on all the stocks in the US market. Here again, you want to compare, right? Whether the model's estimated risk premia is the same as the portfolio's historical record. Okay, the backtesting kind of is like a how much, out of sample cross validation kind of things have to be done. So the first step is generating fitted data. Okay, the product of the factor coefficient and the Fama French factor data. Once the calculation is done, plot the data for a visual review. So we're going to run some scatter plots, okay, like what you see on the right hand side below, like this. Okay, so what you do over here is cross multiplying the beta coefficient with the respective risk premium, okay, that factors, plus the alpha coefficient, not the alpha coefficient, but alpha intercept is added. And then that's estimate, and then you plot this estimate, RP estimate, with return premium that you already have, okay? So estimation versus historical premium, you do the scatter plot like this, it almost the same, very closely aligned with each other. The figure shows that the estimated risk premia align closely with actual data. It's fair to say that the Fama French three-factor model appears to present a reasonably accurate profile of the S&P 500's return. Now, exploratory factor analysis is also there. The fact analysis, right? Fact anal, right? Command, this offers a option for analyzing risk factors. For example, imagine a fund of hedge funds. Portfolio with 6 components, right? Portfolios with 6 components, each representing a particular risk factor. One question that may come up is, what is the least number of factors required to adequately model the portfolio's volatility? So the idea over here is more like a really principal component analysis. In Fama French 3-factors or 4-factor models, you had 4 or 3 factors there, but sometimes you want to reduce the number of variables to explain something. 3-factor, 4 factors, well, reasonably good, but you want to summarize it even shorter with 1 factor. That's the idea. You saw that in previous example in the exercises, that the variables that you use in your regression for right-hand side can be thousands of variables, not just thousands of observations, but thousands of variables or hundreds of variables. The curse of dimensionality is there. So how can we summarize it and extract some commonality out of some of these variables? That's what we're going to do with this principal component analysis. Using the hedge fund returns, okay, in the performance analytics library, let's assume that the factor will suffice. Running fact anal on the returns confirms that a single factor can be used to effectively model the portfolio. Note that this analysis is based on a relatively high p-value of 0.275, which in the case is a indication that the null hypothesis cannot be rejected, i.e. there is no statistically relevant difference between using one factor to model volatility and using the entire portfolio as presented. So summary does not really work in this case, but we can still do some principal component analysis. That's what I'm trying to say. Here you need a performance analytics library, and then we're going to do it like this. The managers in 1 through 6, and then we're going to construct a return data set. And then the omitting the NA variables, and then fit will be constructed, the fit data, the that's facts NL, and then return based on one factors, right? So fit data is constructed and show me the result. Yeah, that's this guy, a list of 12 things, so that you see core over here, factor analysis, right? Return factors, one factor that we specify, we want to summarize it into one factor over here. Uniqueness is shown over here. Loadings of each factors are shown. We visually inspect the one factor model recommendation with PR comp, which performs a principal component analysis, PCA, methodology for reducing the dimensionality of a data set. In this case, portfolio returns, to identify the key drivers, i.e. the principal component of the returns. The next graph shows the sorted eigenvalues variance of the principal components, the factors in a descending order. We call it scree plot. Visual inspection suggests that the first 2 or 3 factors are the key sources of portfolio variability, which implies that the remaining factors can be ignored. So it's a way of, as I said, principal component analysis is an unsupervised learning. You just throw out the variables and the data, and then those will be clustered in the spaces, whatever dimensional space it may be, 2 dimension, 3 dimension, or n dimension, right? It could be. It will be scattered around with some variances, and then the principal component analysis enables you to find out those eigenvectors or the vector spaces that can easily summarize. That follows summarizing means like find out the axis that shows the maximum variance of the distribution. Okay. I'm not going to go detail about the PCA because it requires your mathematical understanding about linear algebra, called eigenvalues and eigenvectors, and then singular value decomposition, SVD, right? Actually, for that part, you need a whole semester of math study. I strongly suggest you to take those courses, but assuming that you have this kind of principal component analysis or eigenvalue kind of understanding in it, right? We're moving on. Again, out of the distribution across many different dimensions, this procedure helps you to identify those new dimension that gives you the biggest variance first. Why? Biggest variation enables you to summarize those distribution very nicely. Okay, instead of identifying the new dimension with minimum degree of variations, widest variation is what we are looking for, and then that dimension is found out in the name of eigenvectors, and then if we plot the principal component of the return, the component, right? Those are eigenvalues, right? Eigenvalue, characteristic value in American terminology. Eigenvalue, eigenvector, that's coming from German language, right? Characteristic, 고유값, 고유행렬 in Korean terminology. The plot shows clearly that the first factor, PC1, is the PC1, this guy, is dominant source of the portfolio's performance volatility. I told you before, the PCA is a procedure to identify one dimension, new dimension, that enables you to describe and summarize the distribution in a very nice, efficient way. For that purpose, you need a dimension that captures the biggest variation, the volatility in this case, right? PC1 is usually a proxy for the market beta. Factor 2 is 2 through 6. By comparison, exhibit decreasing degree of influence. The factors are unnamed and identifying them precisely. The thing is, here, I said this is unsupervised learning. And I said eigenvector is a new dimension that you find out, right? Eigenvector or principal component analysis enables you to find out a new dimension that did not existed, that not showed up in your data before, to summarize the data and then reduce the dimensionality a lot more. The good thing is that the machine finds out, identifies those ways, right? The bad thing is that, well, how to name this thing is a trouble. Okay, the bad thing is, factor principal component 1. It's found out, we can summarize into one factor, but what is that factor about? Here I just, the textbook author explained that majority of it, principal component 1 should be market related factor. You identified it, okay? So we can label it that way based on this author's approach, right? Usually those returns are explained by the market indeed, right? But strictly speaking, we don't even know what that PC1 really means, okay? That's a problem, okay? We just found out a cluster somehow, clustered close to each other, and then we found out a way to summarize it somehow in a certain direction. But what does this really mean? The interpretation is difficult. That's a shortcoming. Anyway, and then the factors unnamed, right? And identifying them precisely can be challenging. By definition, these principal components are mutually linearly independent of each other, orthogonal, right? You can conceive these principal components are the returns of portfolios, some principal component portfolios. To inspect the PCA data, you can save the output from PR comp and print the results. The output reveals that the PC1 represents nearly 62% of the portfolio's variance, like this, what you see on the table. PC 1, 2, 3, 4, 5, 6, and then standard deviation, portfolio's variance, and cumulative proportions. You see this, right? And then standard deviation of PC1 is 0.0644. That tells me that variance of PC1 should be the square of it, which is 0.00415, which is what you see on a scree plot over here. This guy. Yeah. See that? One possible use of the data is replicating one or more of the factor portfolios. For example, to replicate the first factor portfolio using the 6 hedge funds, we can extract the weights for the PCA data by calculating eigenvectors for each factor via the eigenvalues. The resulting portfolios are known as eigenportfolios with the assets weight for the each captured in weight 1. So if we do that, yeah, all right, sum it up to be 1. And then the remaining portfolios target other factors, but as the eigenvalues goes down, its explanatory power about the original portfolio's variation goes down as well. Some of the eigenportfolios may target any number of financial and macro factors such as inflation, GDP, growth, interest rates, etc., etc. But we cannot explicitly know whether they are really capturing them or not. Okay, that's always a problem. Another example of PCA modeling, let's review a portfolio comprised of 5 ETFs, okay, exchange traded funds. For the historical fund prices, we will tap into Yahoo Finance, which is free database via get symbols in a QuantMod package. So we install QuantMod package first. Good. So QuantMod library is activated. Now I corrected the symbols over here: SPY, AGG, EFA, and EM, and OIL. These are the ETFs that we're going to extract from Yahoo Finance database. For free, yes, you can extract it just to specify the ticker symbol like this. And then prices, right, will be created. Let's see if prices are there. Yes, it is. There. Okay, voila. And then the output files for lapply are formatted as lists, which is one of several types of objects available in R. In this task, working with lists makes the necessary cutting and pasting easier. So lapply is useful here, because we need to extract the adjusted closing price for each ticker and then combine the results in one file by column. With the prices file in hand, the next step is generating returns and running the PCA. Okay, returns, okay, and then prices over here, and then principal component analysis is done based on these matrix, and then round the results up to third digit below decimal points like this: PC 1, 2, 3, 4, 5. So factor principal component components are extracted, and then PR comp, return, and plot it. Yes, the first component, second component, third component is plotted over here, and then apply fit rotation, and then these results are shown like this. Okay, so yeah, which component is explaining up to which degree? Okay, yeah, is shown up over here. Okay, thanks for watching.